In Chapter 16, we're going to learn how to account for uncollectible accounts. So another word for uncollectible accounts is bad debts. So all semester we have been recording the sale of merchandise on account. That means that we're giving the customer the merchandise with their promise that they will pay us in 30 days. But sometimes our customers don't pay their bills as they promised. So that is considered an uncollectible account or bad debt. So bad debt is just the expense that occurs from a customer failing to pay on their accounts receivable. So we are going to be looking at two methods of accounting for uncollectible accounts. The first one is the allowance method, and notice that there are two ways of accounting for bad debt using the allowance method. One is the percentage of sales and the other is the percentage of receivables. And then there is the direct write-off method. So with the allowance method, we're attempting to recognize bad debt in the same period that the sale occurred. So for example, in 2021, we may have made a sale in December of 2021 and we recorded the revenue. Remember, when we record a sale on account, we debit accounts receivable, credit sales. So we have taken that sale into our revenue account for 2021. Well, say 30 days is up and it's up in January of 2022 and the customer hasn't paid. And then February comes and the customer hasn't paid. So if we write off their account, then we're going to have our bad debt expense in 2022 and then the sale in 2021. So you see how that doesn't match the bad debt expense with the sale. So the allowance method is going to help us record the bad debt expense in the same period that the revenue occurred. And that way it's consistent with the matching principle. There is a three-step process that's involved with the allowance method. And the first step is to estimate the amount of bad debt expense or uncollectible accounts, that's the same thing, at the end of each accounting period. So at the end of every year, when we're doing our adjusting entries, we're going to also make an estimate to figure out how much we're probably going to incur in bad debt. And that way we're matching up bad debt in the same year that the revenue occurred. The second step is to make the adjusting entry. So we're going to debit bad debt expense and then credit allowance for doubtful accounts. And then the third step is to actually write off the specific accounts when they become known. So if we find out that someone has filed bankruptcy, or we know that they've moved away and we can't find them, we're going to go ahead and write their account out of our accounts receivable. Now we'll look a little more closely at that new account that we talked about for the adjusting entry, the allowance for doubtful accounts. This account is a lot like accumulated depreciation. It's a contra asset account. So in other words, it's going to have a normal credit balance. And accumulated depreciation is contra or opposite to a fixed asset. Allowance for doubtful accounts is contra to the accounts receivable account. So in order to get our net accounts receivable or net realizable value, we take the accounts receivable balance and subtract out the allowance for doubtful accounts. So in other words, we're netting out our estimated bad debt with our accounts receivable. So this is the actual amount that a business expects to collect from its credit customers. Now, when we use the allowance method, there are two ways to estimate the bad debt at the end of each year when we are doing our adjusting entry. The first one is by taking a percentage of our sales. That's the percentage of sales method. So we're basing our estimate on the amount of sales for the year. Or we can base our estimate on the amount of receivables that we have at the end of the year. That's called the percentage of receivables. So a company will choose one method or the other, and they'll stick with that method and then use it consistently. So let's look at an example here for the sales method. Remember, the sales method is basing the estimated bad debt on the amount of sales for the year. Okay, so first of all, before you can do that, you need to figure out what percentage you're going to use of your credit sales. So a company will sit down and analyze and kind of figure out how much they typically write off compared to their sales. So in this example, Chris' company had total sales of $200,000, and they would typically write off about $2,000. So if we take $2,000 and divide it by $200,000, that's 1%. So this company can estimate that they usually write off about 1% of their sales. Okay, so if their current year credit sales are $120,000 and they apply the 1% that they estimated, they come up with $1,200 that they're expecting not to collect that year in bad debt. So the journal entry is debit bad debt expense for the $1,200 and credit allowance for doubtful accounts for $1,200. Notice that the company has increased their expenses by $1,200, and that means that they have lowered their net income by $1,200. So after we have calculated our estimate and then made our adjusting entry, the third entry is going to be to write off any bad debt that occurs in the subsequent year. So for example, during the following year, uncollectible accounts of $1,100 were identified as bad and written off. So that means that we actually have identified a customer who is not going to pay their bill. So we're going to specifically move that customer out of our accounts receivable account. All right, to do that, we are going to debit the allowance for doubtful accounts for $1,100, and then we're going to credit accounts receivable with that customer's name for $1,100. So what we're doing then is reducing the allowance for doubtful accounts by the amount we've identified as bad, and then we're going to remove that customer and reduce accounts receivable by $1,100. One way to remember this entry is that when you're writing off an account, you're physically removing that customer from the books. So that will always entail a credit to accounts receivable. So when you see the words written off or write off, that's going to involve a credit to accounts receivable. Now we're going to look at another way to estimate our bad debt. Now we're still using the allowance method, but the first step is going to be different. We're going to base our estimate of bad debt on the amount of accounts receivable we have at the end of the year instead of the amount of sales that we had. So to do that, we have to prepare an aging schedule, and this schedule details each customer's account balance and how long it's been outstanding. So we're going to really look at each customer separately and figure out what are the chances that this customer won't pay us. So we're going to get a lot more precise estimate of our bad debt expense this way. It takes a little longer. Actually, the computers can generate it pretty quickly. But if you do it by hand, it takes a little bit longer, but we get a much more accurate estimate of what our bad debt will be. So here is an example of an aging schedule. And notice that we have all of our customers who still owe us money at the end of the year over here on the left. And then we have the amount that each customer owes us. And then we're going to break that amount due down by how old it is. For example, we've got W. Billiard, and he owes us $3,000. Well, $2,500 is not due yet, but $500 is 1 to 30 days past due. And then we've got Campbell. He has got $650, that's 31 to 60 days past due, and then a really old one that's 91 to 180 days past due. So we are going to break down each accounts receivable by how old it is. And then we're going to apply a percentage to each category. For example, the accounts that are really old, those that are over a year past due, we're going to assume that we will not collect 80% of that balance. On the other hand, the column that's not yet due, we've got here $65,000 that's not due. We're only going to assume that we will not collect 2% of $65,000. So once we've applied all our percentages to each category here, we'll add up all the resulting amounts to get our estimate for the year. And in this case, we estimate $5,500 as our uncollectible accounts. Okay, so we have our estimate. The next step is to enter the journal entry for the estimated bad debt. But when you're dealing with the percentage of receivables method, you have to think a little bit more than you did with the sales method. With the sales method, we just debited bad debt expense, credited allowance for bad debt for the amount of our estimate. But with the percentage of receivables method, we have to base our adjustment on the amount that's already in the allowance for doubtful accounts. Okay, so let's look at how that works. Now, for the initial entry, we did not have a balance in our allowance for doubtful accounts. So we simply entered the full amount. We debited bad debt expense and then credited allowance for doubtful accounts. So that was our balance at the end of year one. All right, then over in year two, we wrote off $5,200. So when we write off an entry, remember we debit allowance for doubtful accounts and credit accounts receivable. Okay, that gave us a debit in allowance for doubtful accounts with a resulting balance in this account of a credit of $300. Okay, so here's the thing you have to remember about this adjustment. You can't just stick the amount of your estimate in the adjusting entry like we did with the percentage of sales method. You have to make your estimate the ending balance. So it says during the next year, $5,700 was estimated to be uncollectible. So at the end of year two, we've made another estimate so we can create another journal entry. But this time our estimate is $5,700. That means we want our ending balance in the allowance for doubtful accounts to be $5,700. So you ask yourself, what do I need to add to $300 to bring my balance to $5,700? And that's going to be a credit of $5,400. So for year two, our estimate was $5,700, but our adjusting entry is going to be debit bad debt expense $5,400, credit allowance for doubtful accounts $5,400. So that's really the big difference between the sales method and the receivables method. With the sales method, you don't worry about what's in the allowance for doubtful accounts. accounts, you just stick the amount of your estimate in the journal entry. But with percentage of receivables, it's critical to know the amount in the allowance for doubtful accounts because you make your adjustment based on that balance. Then in the subsequent year, we're going to be identifying the actual accounts that are going bad, and we're going to write those off just like we did under the sales method. So we are going to debit allowance for doubtful accounts and credit accounts receivable with the customer name for $500. So remember, anytime you are writing off an account, make sure you're crediting accounts receivable because this is what we're really writing off the customer. Sometimes when customers' accounts go bad and we've written them off, the customer will come back and pay. So sometimes we'll receive amounts from collections toward that customer's account, or the customer will just pay their bill because they want to continue doing business with us. So in this case, we have a check of $500 that was received from Bill McDonald, whose account was written off in January. We received the check in February. So he doesn't have an account now on our books because we wrote him off. So the first thing we have to do when we collect on an account that's already been written off is we have to put the accounts receivable back on the books. So we're just going to reverse the write-off entry. So I'm going to debit accounts receivable and credit allowance for doubtful accounts for the amount that was given to us, and that was $500. And then the second step is to record the collection of the cash. So we're going to debit cash and then credit accounts receivable. So really what we're doing is putting the accounts receivable back on the books so that we can collect it and then just remove the account that we just put on there. Okay, and here's a chart that compares the two methods. Now remember, both of these are the allowance method. Keep in mind that the main difference between the two methods is the basis of the estimate. One is sales and one is accounts receivable, and then the amount that you put in your adjusting entry. If it's percentage of sales, you just put in the estimated amount, and if it's percentage of receivables, you've got to check the allowance for doubtful accounts balance first. Okay, next we'll move to the direct write-off method. This one is a little bit more simple. It's not as widely accepted as the allowance method because the allowance method follows the matching principle. The direct write-off method does not. So basically what happens with direct write-off is we don't make an estimate. The allowance for doubtful accounts does not even exist. We just write off our accounts when we find that they're no longer viable. So we only write off an account and record bad debt expense when we know that we have a bad debt. So the advantages of the direct write-off is that it's simple to apply and it is required for income tax purposes, and the disadvantage is it violates the matching principle because we might have revenue in one year and then the write-off expense in another year. And this will allow some businesses to manipulate their expenses or their net income. And then the balance sheet does not really give you a true reflection of the accounts receivable that you're expected to collect because there is no allowance for doubtful accounts account. But it is simple, so that's the good thing. All right, so here it says that an entry is made only when the account is known to be uncollectible. Okay, so John's account for $500 was deemed uncollectible and was written off. Okay, so here are our keywords here, written off. So that means we're going to credit accounts receivable because we're writing that account off our books. So John's account gets credited for $500, and then we're going directly to bad debt expense. Before, in the other methods, we debited allowance for doubtful accounts, but with direct write-off, we go directly to the bad debt expense account. Here's example 2. Okay, John's account for $500 that was written off is recovered. So as we mentioned earlier in the PowerPoint, sometimes customers who have been written off will come back and pay, and that's what John has done. So we have to be a little bit careful with this entry. If John's account was written off in 2021 and he comes back and pays in 2021, well, it's a pretty easy entry. Then we just reverse the write-off like we did before. We debit accounts receivable, putting John back on our books in accounts receivable, and then crediting bad debt expense. So we're taking the bad debt expense off the books. And then we just record the cash collection. We debit cash and credit accounts receivable. So the steps are the same. We reinstate the account and then we record the collection. Okay, but if John's account was, say, written off in 2021 and he comes back and pays us in 2022, the bad debt expense is gone because at the end of 2021 we zeroed out our expenses. So instead of crediting bad debt expense in the first entry when we reinstate the account, we credit uncollectible accounts recovered and then record the cash collection.